Hello there, Hector Deville here. In this particular video, we are going to be talking about how to define our trading size. Basically, how to know, or how to define how many lots we are going to take our trades with. Well, as you can imagine, there are many different money management formulas. For example, some traders, especially those who like to keep things simple, they follow a sequential order as far as defining their trading size. So, if their account is between $1,000 to $2,000, well, they simply trade 0.1 standard lot, or what's the same, 1 mini lot. Then as they grow their account over $2,000, let's say from $2,000 to $3,000, well, then they pump it up to 0.2 standard lots, and so on and so forth. Between 10,000 and 15,000, they trade one standard lot. Between 1,500 and 20,000, they trade 1.5 lot, etc., etc. Basically, as their account size keeps on building up, well, so they do with their trading size. Now, in my opinion, this is a little bit too simplistic. Right? It's a little bit too simplistic. Again, it's perfectly valid if you just want to keep things simple. You don't want to overcomplicate your money management rules, but like I said, in my opinion, it's a little bit too simplistic. So instead, let me show you the formula that I go for, the one that I use myself on my own trading. Personally, what I like to do is to risk a fixed percentage of my account balance on every single trade, and obviously always applying the same percentage. That means that if my stop loss is hit, I will not lose more than just a fixed percentage, a predefined percentage of my account balance on that particular trade. For example, if I have a trading account with $10,000, all right, and I decide to risk, I don't know, let's say a 3% of my account size on every particular trade. Well, that means that if my stop loss is hit, if that trade becomes a loser, I will not lose more than $300, because 3% of 10,000 is 300. All right. So what am I achieving with this? Well, I am predefining my risk on every single trade. Okay. I know that no matter what, I am going to lose just $300 on this particular trade. Obviously, let's assume indeed that trade turns sour. Okay, my stop loss is hit. Well, for the next trade, I will have on my trading account 9,700. Right? Well, that means that for the next trade, I am always obviously to apply the same percentage, in this case 3%. Well, I will need to calculate 3% of 9,700, which I've already calculated this. It's $291. All right. So if on the next trade my stop loss is hit, I will not lose more than $291. In the other hand, let's assume that the trade didn't hit my stop loss. Instead, it became a winner, and now I have 10,000 and, I don't know, for example, $500 on my account size. On my trading account. Well, 3% of that is $312. All right. So obviously, as my account size, as my account balance is increased, I will be able to risk more and more on every single trade, and therefore I will be able to increase my trading size, okay, my lot size. That's the idea here. You always risk exactly the same percentage of your account size on every trade. So one given trade doesn't make or break your trading account. At the end of the day, you are always risking the same amount, all right, which is again a 3% of your account. So you treat every single trade in the same way, all right. You don't over leverage your account on any given trade, since again you will be risking exactly the same percentage on every single trade. This is important, guys. Okay, so no given trade again can make or break your trading account. That's the idea here. Now, to be more specific, the formula we're going to apply here is stop loss size in pips, all right, in pips, multiplied by the pip value for that particular currency pair should equal your account balance multiplied by the risk percentage that you are going to be applying to your own trading, okay, depending on your risk profile as a trader. Don't you worry about that. We are going to talk about that in a second, but for the time being, just please get this idea. You should be calculating in pips your stop loss size, 30 pips, 40 pips, whatever. Then the pip value for that currency pair. Not every currency pair has the same pip value. For example, one standard lot of the euro against the American dollar is worth 10 bucks, $10. All right. If you are trading one standard lot on the euro against the American dollar and you make, let's say, 10 pips, 10 pips, well, you multiply 10 pips by $10, and obviously you will make $100 of profits in that particular trade. Okay, but that's on the euro against the American dollar. If you are trading the euro against the Japanese yen, or the American dollar against the Swiss franc, or the sterling pound against the, I don't know, any other currency pair, it doesn't really matter. Every different currency pair has its own particular pip value. All right, so you need to take that into consideration in case you don't know any website where to look the pip value for each particular currency pair. Under this video, on the resource link section, you will find a link to a small website where you can calculate very quickly the pip value for each particular currency pair. All right. Anyway, once you know the pip value for that currency pair, and that once you know how many pips you are risking as far as your stop loss goes, well, you can easily identify or determine how much are you risking money-wise on that particular trade. If you are trading, again, one standard lot of the euro against the American dollar, that means that every pip for your trade is going to be worth $10. Okay, assuming you have a stop loss, I don't know, let's say for example 45 pips. Okay, just as an example. Well, then that means that $10 multiplied by 45 pips, you are risking $450 on that particular trade. All right, and that should obviously equal. That should be in line with your desired your desired risk levels. Okay, meaning how much are you going to risk of your account balance on each particular trade, and again that should be $450. Now, before we continue digging into this formula, we need to establish one of the factors, one of the elements of that equation, which is the risk profile. I'm sorry, the risk percentage that you are gonna apply into your trading, and that depends on your risk profile as a trader. I am afraid that that's not something I can answer for you. That's something that you will have to decide by yourself. I'm just gonna give you some guidelines here. All right, but again, ultimately the decision is entirely up to you. If you are a super conservative trader, you want to risk less than 1% of your account balance on each individual position. This is usually the approach that big fund managers or traders working for investment banks, those kind of people usually follow. The reason for that is because their account balance is massive. All right, they trade millions of dollars, sometimes tens or even hundreds of millions as per their entire portfolio, and therefore they just don't want to risk too much money into each individual position, so they simply risk very little on every single trade. Now, in the other end of the spectrum, we have super aggressive traders who look to risk over 5% of their account size on each individual trade. I don't know, 6%, 7%, 10%, etc., etc. Now, I gotta be honest with you. This is something that I just cannot recommend. I just cannot recommend you to be risking 6, 7, 8, 10% of your account on each individual trade. That's just not healthy from a trading point of view. At the end of the day, please remember that your goal is to have or to develop a mild and stable equity curve in your account portfolio, or in your account on your trading account. All right, that's more or less the ideal equity curve in the long run. In the other hand, If you trade or if you risk, let's say, 10% of your account balance on each particular trade, you will find your equity curve to look something like this, something chaotic like that. Even if at the end of the day you are on top, okay, meaning that you are indeed making money, but this is not the ideal equity curve. You'll be probably will be over leveraging your account. Your stress levels are going to be insane, and again, quite frankly, from a trading point of view, it's just not a healthy equity curve. Okay, so since in one hand being ultra aggressive is just not recommendable, and in the other hand your account balance is probably not large enough to be an ultra aggressive trader, well, these are the three options left. Alright, conservative, moderate, and aggressive, risking between 1% and 5% of your account balance on each particular trade. Again, depending on your risk profile out of these three options. Between 1 and 2% if you are conservative, around 3% if you are moderate, or between 4 and 5 if you are aggressive. My advice, my personal advice, just be moderate. Okay, 3% is a it's a sensible middle point. Is the sweet spot. All right, as far as money management goes, risking 3% of your account size is more than appropriate. So from now on, okay, every time I go back or I refer into this formula, I'm gonna be assuming, or I'm gonna be replacing this factor here for just a 3%. If you are a conservative, you decide to go the conservative way, well, simply switch that from 1 to 2%. Okay? But like I say, just for the sake of discussion, from now on, I'm going to be assuming that you are risking a 3% of your account on each individual trade. Okay? Alright, finally, now that we know all about the formula we are going to use, and now that we've decided on our suitable risk profile as a trader, well, it's time to actually be able to calculate our trading size, our lot size for any particular trade. Obviously, what we are going to be doing is to simply apply a 3% of our account balance, and we are going to divide that by the stop loss value in pips. All right, multiplied by the pip value on that particular currency pair. Let me give you a hypothetical trade. So let's assume our current account balance is $5,000. Our risk profile is moderate, and therefore we'll risk 3% on each individual trade. Our stop loss, the distance between our entry point and our stop loss point, is 45 pips, and the pip value for this particular currency pair, whatever currency pair it may be, it doesn't matter. This is just a hypothetical case. Well, the pip value is $9.20. All right, so let's figure out how many lots are we to take this trade with. We are going to calculate first this first portion of the equation and then the second one. So let me bring my calculator forward. That's $5,000 multiplied by 0.03, meaning 3%, and that's 150. All right, so this first portion of the equation equals to 150. Now let's go with the second one. Stop loss 45 pips multiplied by the pip value $9.20. That's 414. So let's divide 150 by 414. Okay, so that's 150. Oops, sorry about that. 150 divided by 414. That's 0.36. All right, 0.36, which I actually have it here. Right, 150 divided by 414. It's 0.36 standard lots, or what's the same, 3.6 mini lots if you are trading through a mini account. All right, so you would take this trade with 0.36 lots. Now, please notice how we've gone around tweaking our lot size in order to satisfy or to fit the 3% rule. All right, on this first part of the equation, we are defining how much we are comfortable how much money we are comfortable losing if our stop loss is hit. All right, basically how much we are willing to lose on this particular trade. And then on the second portion of the equation, what we defined is how much we can potentially lose if we are trading one standard lot. Okay, so by dividing these two elements, these two factors in this formula, we are simply altering the lot size. So we are not just going to take the trade with one standard lot, but we are going to take however many lots we are to take if we want to keep the 3% rule in place. All right. Finally, you will of course notice that the bigger our account size is, all right, the more funds we have at our disposal, the larger the trading lot size. Okay, if this goes up, this is going to go up. Conversely, the larger the stop loss is, all right, basically if this figure up there goes up, then the lot size is going to be reduced down. The more funds we have on our account size, the more lots we are going to trade. But on the other hand, the larger the risk in pips, the more we need to cut down on our trading size in order to continue satisfying that 3%. Let me just put that in actual numbers. Instead of having $5,000 account, let's assume we have a $75,000 account. All right. Let me again bring forward my calculator. So $75,000 multiplied by 0.03, that's 2,000, all right, 2,250. I'm gonna alter that there. 2,250. Okay, and obviously 2,250 divided by 414, that's 5 lots in 5.43 standard lots, or what's the same, 54.3 mini lots. Okay, you see, the more and more we grow our account, the more lots we'll be able to trade, okay, on our daily trading process. In the other hand, let's imagine that instead of taking a trade where the risk is just 45 pips, I mean the stop loss size is just 45 pips, instead of that, let's change that to 125 pips. Okay, well, now if we multiply 125 pips times $9.20 per pip, that's 1,150. So we need to change that, 1,050, and let me actually make that a little bit wider so it fits on my screen. All right, so now we need to calculate 2,250 divided by 1,150. All right, just give me a sec. I'll be done in a minute. All right, 1.9 lot.